So that's one. Now we got another one of these suckers. We've got another refundable one. This one is called, we're skipping ahead to part 4 tax. So this is the next one that we're going to talk about. So let's go ahead and talk about this one. So we're done with the additional part 1 stuff and that refund. We have another potentially refundable tax, and this one's called part 4. We've skipped ahead. There's no 2 or 3 to worry about. We're going right to part 4. So in this example, we have $100,000 of investment income. That money goes to Company A. Company A is going to pay $54,000 of tax and has the potential here for this $28,594 refund. Same numbers we were looking at here. There's $74,594 retained. Exact same numbers as this example. So again, this is the dividend amount that's available because the refund has given us back $28,594. Without this, we would only have $46 in the bank. So Company B, if this money goes from Company A to Company B has retained the $74,594. Well, Part 4 tax. This is a liability. This is for private corporations. You know, if you do work here in Halifax, we have a lot of the work you'll do is probably going to be with CCPCs, Canadian controlled private corporations. That's where a lot of the work comes here locally. Also, subject corporations. That's will be liable for this tax. That is a corporation other than a private corporation who is resident in Canada and controlled by or for the benefit of an individual or related group. For the purposes of Part 4 tax, they are treated as a private corporation. We're going to talk about this whole related groups, related associated, and a bunch of stuff like that in Chapter 14. So don't worry too much about this subject corporation thing for now. But private corporations is where you're going to see this Part 4 tax. Part 4 tax is assessed at 38.33%, and it is also refunded at the exact same rate, 38.33% of, once again, taxable dividends paid. So we're talking about the same sort of thing, a refundable tax. Where is this applied? Well, this is for dividends that are received from an unconnected company, i.e., portfolio dividends. So a dividend that is received from an unconnected company, i.e. a portfolio dividend. We'll define a connected company in a moment. The other one is a dividend that is received from a connected company, and the company paying the dividend received a dividend refund as a result of the payment. So we're working now with money going between corporations. With the Part 1 additional refundable, we were looking at the corporation, earning it. We were ignoring dividends coming in, the same ones that we were taking out for tax purposes, they weren't a part of that calculation. So we're kind of coming over here now and picking up those dividends that are flowing between companies. That's what the Part 4 one's about. So this could be dividends received from unconnected companies, a portfolio dividend we'd call that, or dividends received from a connected company, and that connected company has received a dividend refund. So in other words, you float it through from one company to the other, got your dividend refund, and now we're looking at it. So let's take a step back here and define this connected company. So what we're talking about here is corporations, of course. So a connected corporation is a controlled corporation, is one example. So this is an either or. This situation here, we're saying either or. So one or the other. So first of all, a controlled corporation, control being defined as greater than 50% of the voting shares by any combination of the other corporation and persons with whom it does not deal at arm's length. So basically, one corporation is connected to another one that it controls through those voting shares. And to control, that would be more than 50%. Or the second one is a corporation in which the other corporation owns more than 10% of the voting shares. And this is an and 10% of the fair market value of all issued shares. Remember, every share issued isn't necessarily going to be a voting share. So if there's different classes of shares and some are voting and some aren't, we need 10% of the voting and 10% or more of the fair market value of all shares issued. So this is a greater than or equal to 10%. So it's kind of worded in a weird way. Obviously, if you control a company, then you're connected to it. You control it. But the real bar here is simply greater than 10%. That is of voting and fair market value. So it's a very low bar. If you have both, then 10% is all we're looking at. So that 10% in practice, that 10% shareholding test is generally what we would use to determine if these are portfolio dividends or dividends from a connected corporation. So we use that 10% test to figure out which this is. So we've already defined eligible dividends. There again, non-eligible dividends. You guys learned that back in Tax 1. So CCPCs, their income is often first eligible for small business deduction. We learned that in Chapter 12. Investment income is often eligible for a refund. This assumes most dividends are non-eligible. So there are exceptions for the general rate income pool. We keep track of that, by the way, that general rate income pool, so we can figure all this stuff out, all these dividend refunds and everything. For public companies, most of the income is going to be taxed at the general rate. So this assumes that those dividends are eligible, and then we're going to have exceptions for your low rate income pool. So you may be asked to calculate these income pools. So we have a nice little formula for that to calculate our GRIP. And this is something we continue to track. This is a cumulative total. So C is going to be your opening balance. Then we're going to have D, 72% of the adjusted taxable income for the year, which is regular taxable income reduced by the amount eligible for the small business deduction. We talked about that a little while ago. And the lesser of the CCPC's aggregate income and its taxable income for the year. So these things, I mean, really, this is a pretty dry topic, obviously. Make sure you refer back to this stuff because there's a lot of information there in particular. So make sure you're calculating against the right thing. What is adjusted taxable income? What's aggregate income, investment income, all these numbers? Make sure you just refer back, have those things available to you so you can refer to them. E is the eligible dividends received during the year. F is any adjustments for amalgamations or wind-ups. I'm not going to give you a big complicated amalgamation or wind-up question. Tax 2, again, is, we're working on some of the basic stuff here in chapter 11, 12, 13. And then, as we kind of continue, some of these chapters, they could be a whole course, right? It gets into some topics you could really get into, but we're still really just introducing these topics. We're trying to give you the basics here, and I don't want to get too mired in too many, really complicated items that you're not going to necessarily see day one in the job. But just know that amalgamations and windups, there's some different stuff for that. This is when groups of companies are joining together or a company is shutting down, ending its life cycle, so to speak. G is eligible dividends paid during the preceding year. It's highlighted. It's not the current year. It's the preceding year. So that's how you would calculate what is available in that income pool. Why does that matter? That's the pool of income from where you will pay your dividends. And then we have to follow the appropriate rules for those dividends. So these would be eligible. Out of your GRIP comes your eligible dividends. That's what this slide is saying here. As much as you have in your GRIP balance, you can have eligible dividends. And they have a little bit of a preferential tax treatment because more tax has already been paid because it was paid at the high rate in the corp. And our LRIP, our low rate income pool, we got a big old crazy calculation for that one too. If you like punching formulas, there it is. Again, this is a cumulative kind of all-time carry forward balance. So we have the opening balance from the end of the preceding year is where we start. So that's always going to be A. Then the non-eligible dividends we received for the year. Because again, these corporations can be paying these dividends to each other, to connected corporations, to corporations that control them. So it's not always going to an individual. It can be going to a corporation. So we have to flow these things through properly. In the big picture, again, it's about keeping the characteristics consistent so that we don't change the tax treatment as the income moves through, maybe a more complicated corporate structure. So your non-eligible dividends are what's going to get paid out of your low rate income pool. So they'll be categorized as non-eligible, and they have a less preferential treatment to the eligible ones because they've been paid out of a pool of income that was more likely small business deduction rate and had the lower corporate income tax paid to come along with it. And all of this stuff, all of this nonsense is to try to keep that integration, try to eliminate the benefit of kind of moving this money around to maybe defer when the taxes need to be paid. Instead, as you move it around, you create a bigger tax bill so that you have to, or as you earn the investment income, you have that bigger tax bill until you move it along. But then if it just moves along to another corporation, now it's that corporation's problem. We're trying to push it down the line to the individual so they can pay that final amount of tax to lessen the amount of the deferral. That's what all of this, that's the goal of all of this. So it's all still about integration. We make elections on the tax return for this. So you have to specify when you're paying a dividend, you elect to pay it out of one pool or the other. So it's important that you've done your due diligence and you know how much is in the GRIP, how much is in the LRIP, and so you properly take it out. So there can be some tax if you do an excessive election, if you go past what you had left in the pool, 20%. If it's an artificial manipulation, 30%. So there's some punitive stuff in there for overdoing it, right? Because this can drive dividend refunds and all this stuff. So you got to track those balances carefully and not make any mistakes, or certainly not artificially manipulate it on purpose. So then we have another one here. Refundable dividend tax on hand. This is how much we have in the pot. So in other words, if you have paid the additional taxes, right? So you're paying those along the way, you're building up a pot until you pay the dividends to the individual. So, you know, whenever this, let's just to kind of simplify it, you know, you've got this investment income. So you got this investment income, you know, it's coming into your corp, and then you're paying taxes on it. You know, you're paying these refundable taxes, the Part 1 and the Part 4. So you're building up a pot of refundable taxes. That's our RDTOH. That's a D. Refundable dividend tax on hand. This is another cumulative pot. So we're calculating along the way here, how much have we paid that extra tax on? Part 4 and Part 1. How much extra do we have sitting in the pot, which is refundable? Once we pay the dividends out, then we can refund it. Now, there's been a change to this, you know, just to kind of complicate things a little more here. So before 2019, so this is a change for the current tax book and for the current tax rules here. So before 2019, a company would just maintain one account for all of this. So it was more simple. We've complicated it a bit more. So all of your refundable taxes were dumped into one pool. And then your refund was the lesser of 38 1/3 of any taxable dividends you paid, or the balance left in that account. So that was pretty straightforward. You pay out the dividends, you can get back your 38 1/3% up to whatever's left in that pot. Over and above that, they're just regular dividends. or I should say, they're dividends that have no effect or have no refund coming to them. Now, from 2019 forward, we've got some new rules. And basically, instead of having the one pot, now we've got two pots. And one is for your eligible refundable dividend tax on hand, and one is for your non-eligible. We're going to keep track of them separately now. So there's no refund on eligible dividends if there's no balance in your eligible RDTOH. So it's a little more complicated, but it keeps track of it evenly. So you used to be able to just pay it right out of one pot and it didn't matter. Now you have two separate pots for that. So the importance here is that non-eligible dividends are taxed at a higher rate than eligible dividends. So in other words, if you want to access, that's what this one here is saying, if you're trying to access the refund and get the dividend to a person in the most tax beneficial way for them, for the individual taxpayer, it's a little more challenging to do that now because you have to take it out of the appropriate pot. In other words, once your eligible dividend, refundable dividend tax on hand pot is gone, you can keep paying eligible dividends. However, they may not get you a refund. So you may need to go over here and pay some non-eligible dividends to clear out what's in that pot. It used to be it didn't matter. It's one big fat pot. So it's a little more complicated now with that, and a little more complicated because we have to track them in those two ways. So how do we get there? There's some transitional provisions for this. I'm not going to give you guys a big complicated question about the transition, because obviously if we have one pot, we need to get to two pots and then move from there. So that's kind of a, that's only relevant for 2019. So we're not going to spend too much time on that, but there's information there in the text for you on that and about how you kind of transition through. So there's slides here for everything that goes into those two pots. Let's see here, your eligible refundable dividend tax on hand, Part 4 taxes on portfolio, Part 4 taxes on eligible, of course, deducting. So you have an opening balance, you add stuff, you deduct what you pay out, right? Just a running tally of that pot. Same thing for the non-eligible. What did you start with? We got to deal with the transitional rules, but what did you start with? Plus the additions here, it's the Part 1. So that goes in the non-eligible. We already learned those. And then Part 4 on eligible. So this was Part 4. So for the eligible RDTOH, it's Part 4 taxes on eligible dividends received from connected companies. I want to just highlight for you guys here. This is the difference. Right? Refund on non-eligible, refund from eligible. That's the difference here. So these two both include Part 4 taxes related to connected companies, but this is for the non, and this is for the eligible, because we have pots for each of those now. That's the key difference there. And This non-eligible is where all your Part 1 stuff goes. And this eligible is where the portfolio dividend Part 4 taxes go. So basically the rule to keep in mind here is that all of this stuff, when you've got your general rate income and your lower rate income, that's 2 lanes, and everything's got to flow in those 2 separate lanes. If you're doing dividend refunds on eligible and non-eligible, it's all tracked now fully individually through the whole life cycle. And so you can only pay from those groups. And you're going to have the tax implications of that. These ones a little bit.